You think things have been bad? We are right now entering the worst, potentially the worst time for the stock market in the last 12 months. Earnings season is going to be, could be, and most likely going to be a disaster. So hold on tight. Yeah, this is Investing Confidential. Just back from Europe. We talked about this counter trend rally coming. Everyone was bearish. We had the rally. It lasted a couple days and then faded. Now, why did it fade? Because the components just aren't there to rally. I mean, you don't have cheap stocks. You've got a lot of headwinds coming. So basically, these kind of rallies are going to continue. But the trend is not your friend. The trend is lower. The trend is negative. These counter trend rallies could last more than 2 days. They could last like they did in July, a month, 3 weeks or so. They're going to keep coming. They keep coming in different assets, but basically the trend for financial assets is lower, and that is because we are finally normalizing interest rates. And that means that rates are going higher. The dollar is going to continue to come stronger, and that's going to be a headwind for all financial assets. So as we head into earnings season, we could look at a couple things. We've discussed this before that the big risk is going to be earnings season, and let's just go through some reasons. So let's first look at financial conditions. Financial conditions indexes are almost heading to 2008 low. It doesn't matter if in this case it's the Jeffries. You could look at Goldman Sachs financial conditions, anyone's financial conditions index. You're going to find when you look at these indexes, which take into consideration not just asset prices, but also other financial indicators that are just getting worse and worse. And we are heading to the 2008 lows. Now, the interesting part is this is a leading indicator, okay? So the stock market is not really reflecting these financial indicators. So it definitely looks like we are going to be heading lower. One of the main reasons is obviously the interest rates going higher, not just in the U.S. but around the world. But right now, the U.S. dollar is certainly going to be a big headwind for earnings season coming up. When you look at historically speaking, earnings declines on average in a bear market or recession, whatever you want to call it, they average around 13%, as you can see here. But I think things are going to be much worse because we haven't seen a combination of what we're seeing today, which is stagflation, rising dollar, consumer demand dropping off the cliff all over the world. So we're going to see earnings declines much worse than the average, which is 13%. And by the way, we haven't even seen that yet. So remember, what we're seeing today is third quarter earnings. Okay, so we're going to get third quarter earnings, which are going to be okay, but it's really the guidance through the end of the year, the guidance into 2023 that we're going to focus on, because guidance is what drives markets. Okay, the reported earnings, most people have an idea what the numbers are going to be. Obviously, in some cases, it's going to be much worse than expected, but you're going to see the large companies report numbers around where they should be, with the exception of Apple. I don't think anyone knows where Apple's going to report, but it's the guidance that's going to matter. So whether it's Tesla, whether it's Apple, whether it's General Electric, US Steel, it won't matter what the earnings are. It's actually going to be the guidance. So focus on that. What's the headwind? The dollar is the number one headwind right now. It's affecting any company that sells things overseas. It's affecting consumers, affecting everything. And so the dollar is going to be a massive headwind. Now you could say, the bulls will say, oh, well, that's just temporary. Well, it's not temporary, because I think we're going to see, as everyone believes, we're going to see the Fed continue to raise interest rates through at least the first quarter of next year. And maybe at some point they'll pull back. But the dollar is just not all of a sudden going to weaken in the next 6 months. Now, over time, I think the dollar is going to weaken dramatically. That's why I think gold is going to be very interesting at some point. But that's over medium to longer term. We're looking here at short-term indicators. So right now, the dollar will continue to be a headwind, again, for exporters. And also tech companies, as we talked about before, whether it's Apple, whether it's Microsoft, these companies sell overseas, and they're going to be affected by the dollar. So when you hear the talking heads on CNBC or even on YouTube saying that the market's looking cheap on the PE basis, don't believe it. Remember, what is a PE? Price over earnings. earnings have not even begun to decline. Okay, not even begun to decline. And everyone uses, especially for indexes, right? So whether you're trading S&P, Qs, Nasdaq, whatever the futures or indexes you're trading, they're based on consensus, right? So all these Wall Street people, whatever it is, doing. By the way, they're not good. They're always wrong. But when you put a consensus together, that's how you come up with the PE for the market. And so as the E goes down and the price go down, you're not going to see cheap. The stocks are going to continue to look expensive until we see a complete collapse and a stabilization in earnings. So don't take that. Don't listen to talking heads saying things are cheap. Now the other thing to indicate is you have the Nasdaq is off maybe a couple of years, right? So it's taken out a couple of years of appreciation. Again, looking historically back on charts like this, we need more. We need really demand. We need destruction of 5, 10 years of returns in order to say, hey, the markets are looking interesting now. This is not enough. So we think this is another indicator that no matter what the talking heads say, the markets are not cheap and we are probably going lower over time. Remember, over time, not tomorrow, because we could rally this afternoon, tomorrow, it doesn't matter, but the trend is lower. Everyone's focusing now here. Now that earnings are going to be really bad, and as we go into the rate hike or the rate decision, excuse me, it's going to be a hike in November. 75 basis points, as you can see here, is starting to get baked in. The consensus was after the last rate cut, 50. It's going to be 75. They have to do it. If they don't, they're going to lose all kinds of credibility. So the Fed most likely will do 75 bips, which is going to be negative because certainly the market was expecting 50, and they were expecting a pivot. There's no pivot coming anytime soon. But has inflation peaked? I think it has. We are seeing mixed signals though. Okay, so we're looking at container prices, as you can see here. This is a big indicator that this is stuff being shipped in. It's a global indicator, but certainly the price of goods coming into this country are coming down. That's very positive for consumer inflation. Again, I don't think inflation is coming down dramatically, but I think it certainly has peaked. But on the other side of the coin, we have oil, we have gasoline starting to spike up again. And I think I mentioned this before. This is the phenomenon of the White House using the strategic oil reserves to artificially, bang down oil and gasoline. Other countries know it. The OPEC knows it. That's why they came out last week and did what they did. So the government can do whatever they want to do, but all they're doing is depleting our strategic reserves. And at some point, they're going to have to fill it up. So this is a game. The White House has lost the game with strategic oil reserves, unfortunately. And it's going to blow up in our face. And so again, it continues to be a headwind, but this is why I believe inflation has come down, but I also believe that it's going to be sticky, right? So it's not going to come off to 2% like the Fed thinks. I mean, please, it's ridiculous. It's going to come down to, let's say, again, in a 6-month period, 5%, maybe 4.5%, but that's still very, very high historically. I want to mention a couple things that I think are just ridiculous. Atlanta Fed has this thing I've mentioned before called GDP now. Basically, it's a manipulation of the numbers, saying it could be, GDP for there could be 2.8%. I mean, give me a break. I mean, we just had 2 negative quarters of GDP. Sure, it could rebound, but 2.8%, given what everything going on, given real estate collapsing, all this, I mean, it's just hard to believe. But again, they're faking the numbers. Don't believe this GDP now when you hear it. You're going to hear it a lot because it's going to be better than the real GDP numbers. But again, it's fake numbers, so disregard it. Again, I just mentioned real estate. Housing sales are dropping. We talked about this before. The reason behind this is not material. The mortgage rates are not really material in the short term. They're going to be material over time. But the main reason housing prices are dropping is because the large institutions, the Blackstones, the Open Door. By the way, Open Door just hit a new all-time low at under $3 a share. Zillow, etc., were buying thousands of homes sight unseen. They caused a massive bubble. The bubble's been popped. They're losing their shirts. They're selling inventory. Housing prices will go lower. Not because of mortgage rates, but because there's going to be a lot more supply on the market, and we're already seeing that. The other thing, another contributing to inflation, also bad for the housing market, is apartment demand is dropping off the cliff again. What does that mean? Rents are going lower. So when you hear the talking head saying, oh, rents are going to be up and this and that's unaffordable, don't believe it. Have patience. Rents are going lower. Don't let some landlord bully you saying that it is too much demand for rent. I don't care where you are right now. Certainly not in California. New York is dropping. And unfortunately, because of the hurricane event, which I think popped the bubble for Florida. Okay, the hurricane event, Hurricane Ian, and we say our prayers to all the people that suffered during that, especially people who passed away. That hurricane has popped the Florida real estate bubble. No matter whether it's Miami, no matter if the hurricane hit on the West Coast, Miami is popped, Orlando is popped, Sarasota's popped. Prices are going lower. And in the case of Florida, significantly lower. Okay, and that's based on supply, demand, pricing, and people now are worried about future events, so they're not going to go down and just overpay for Florida real estate. Since I just came back from Europe, I do want to mention something. I continue to mention something that's really important, is this UK situation. Okay, as I mentioned, the UK intervened. It worked for a little bit. It's not working. It's reversing again. The bond market's selling off. The currency's selling off. Intervention doesn't work. Okay, it may work for a day or two, but it doesn't work over time. The pension issue is not going away. Okay, this issue with all of these derivative schemes that they use to try to match assets and liabilities, which I talked about last week, is going to continue to hurt the UK government, the UK consumer, and now we're seeing signs again here. It's going to hurt the UK corporates, financials. It's going to hurt their cash flow. It's going to hurt their earnings. Okay, why is this important? Because this phenomenon that happened in the UK is going to happen. It's happened all over the world. Every pension fund around the world has done the same things. They've bought, long duration bonds into a declining interest rate market. In some cases, all-time low, negative rates, 1%, below 1%. These pension funds are screwed because people are, as you can see, you don't have to take my word for it, people are retiring at record numbers. They want their pensions. Pension funds now have liabilities are building while their assets are declining significantly. Bonds and stock markets are declining. So bonds and stock markets are declining. What does this mean? That means companies are going to have to fill the gap, or the government. So if the company can't do it, it's the government. But in the short term, it's going to hurt corporate cash flow. It's going to hurt corporate earnings. Another thing to contribute to what we are in, which is a bear market. So no country is immune. It's coming to the U.S. This pension fund fiasco is coming to the U.S. We already see it in the UK, the rest of Europe, Canada, Australia. It's going to hit everybody. So just beware. Oh, I forgot to mention one last thing. I keep forgetting all the time. Please subscribe. Okay, I'm just starting this YouTube channel. It's brand new. I hope I'm offering some value based on what I'm seeing out there. I think I'm giving some information that's different. Please subscribe when you had a chance. And as always, traders, happy trading.